The preparation of a cash flow statement stands as one of the cornerstones of financial reporting, offering a dynamic view into the liquidity and solvency of a business. Unlike the income statement, which measures profitability, or the balance sheet, which captures financial position at a point in time, the cash flow statement traces the actual inflows and outflows of cash within an organization over a defined period. This document is indispensable for stakeholders, managers, investors, creditors, and regulators alike, who seek to understand not merely how much profit a company reports, but how that profit translates into liquid assets that can be deployed for growth, debt servicing, or distribution to shareholders. The importance of the cash flow statement has only grown in modern business, where complex transactions and accounting practices can sometimes obscure the true financial health of an enterprise. The cash flow statement is typically divided into three main sections: operating activities, investing activities, and financing activities. Each section serves a distinct purpose in illustrating the sources and uses of cash within the organization. Operating activities reflect the core business operations, essentially the cash generated or consumed by selling goods or providing services. Investing activities encompass cash flows related to the acquisition and disposal of long-term assets, such as property, plant, and equipment, or investments in securities. Financing activities detail the cash flows arising from transactions with the company's owners and creditors, including the issuance or repurchase of shares, borrowing or repaying debt, and payment of dividends. The process of preparing the cash flow statement can be approached via two primary methods: the direct method and the indirect method. The direct method involves listing all major classes of gross cash receipts and payments, such as cash received from customers and cash paid to suppliers and employees. This approach provides a granular view of cash movements but is often more challenging to implement due to the need for detailed cash transaction records. The indirect method, by contrast, starts with net income as reported on the income statement and adjusts for non-cash transactions, changes in working capital, and other items to reconcile net income to net cash provided by operating activities. While the indirect method is more commonly used in practice, both methods ultimately yield the same end result: an accurate depiction of cash flows during the reporting period. To begin the preparation of a cash flow statement, it is essential first to gather the necessary financial data. This includes the current and prior period balance sheets, the income statement for the period, and any relevant supporting schedules or notes. The comparative balance sheets are particularly important, as they enable the preparer to identify changes in asset, liability, and equity accounts that underpin the various cash flows. The income statement, meanwhile, provides the starting point for the operating activities section, especially when using the indirect method. For operating activities, the indirect method commences with the net income figure. Since net income is calculated on an accrual basis, it must be adjusted to reflect only actual cash transactions. Non-cash expenses such as depreciation, amortization, and provisions are added back to net income, as these do not involve a cash outflow. Conversely, gains on the sale of assets or investment income, which may have been included in net income but relate to investing or financing activities, are deducted. The next step involves adjusting for changes in working capital components: accounts receivable, inventory, prepaid expenses, accounts payable, accrued liabilities, and other current assets and liabilities. Increases in current assets represent uses of cash, while decreases signify sources of cash. The opposite holds true for current liabilities. These adjustments ensure that the cash flow statement accurately reflects the cash generated or consumed by the company's core operations, free from the distortions introduced by accrual accounting. The investing activities section of the cash flow statement captures the cash effects of transactions involving long-term assets. Cash outflows typically arise from the purchase of property, plant, and equipment, intangible assets, or investments in other entities. Conversely, cash inflows occur when such assets are sold or otherwise disposed of. For example, if a company sells a piece of machinery, the proceeds from the sale would be recorded as a cash inflow under investing activities, even though the gain or loss on the sale would have been recognized on the income statement. Similarly, purchases of marketable securities or the acquisition of another business would also appear in this section. It is critical to distinguish between actual cash paid or received and any non-cash transactions, such as the exchange of assets or the assumption of liabilities, which must be disclosed separately in the notes to the financial statements. Financing activities, the third component of the cash flow statement, reflect cash flows related to the company's capital structure. Common examples include cash received from issuing shares or borrowing funds, as well as cash paid to repay borrowings, repurchase shares, or distribute dividends. These transactions are crucial for understanding how a company funds its operations and growth, and how it returns value to shareholders. For instance, a company that consistently raises cash through debt or equity issuances may be signaling expansion or, alternatively, covering operational shortfalls. Meanwhile, significant outflows for debt repayment or dividend distributions may indicate financial stability or, in some cases, a lack of viable growth opportunities. Throughout the preparation of the cash flow statement, accuracy and attention to detail are paramount. Misclassifying transactions or omitting non-cash items can lead to a distorted picture of the company's liquidity. For example, suppose a company acquires equipment by issuing shares rather than paying cash. While this transaction affects the company's asset base and equity, it does not impact cash and should thus be excluded from the body of the cash flow statement, though it must be disclosed elsewhere. Similarly, foreign currency translation adjustments, changes in accounting policies, or corrections of errors may necessitate additional disclosures or restatements to ensure comparability and transparency. Once all relevant cash flows have been identified and classified, the final step involves reconciling the net increase or decrease in cash and cash equivalents during the period. This figure, when added to the opening balance of cash and cash equivalents, should match the closing balance as reported on the balance sheet. Any discrepancies must be investigated and resolved before the cash flow statement can be finalized and presented to stakeholders. This reconciliation serves as a vital control, ensuring the integrity of the financial information and providing assurance that all material cash movements have been captured. The preparation of the cash flow statement is not merely an exercise in compliance, but a powerful tool for financial analysis and decision-making. By illuminating the sources and uses of cash, the statement enables managers to assess the sustainability of operations, the adequacy of internal funding for capital expenditures, and the company's ability to meet its obligations as they come due. Investors and creditors, in turn, rely on the cash flow statement to gauge the risk and return profile of their investments, identify potential red flags, and compare performance across companies and industries. In practice, the preparation of the cash flow statement often involves overcoming a range of challenges. Data quality and availability are perennial issues, especially for organizations with decentralized operations or legacy systems. Reconciling differences between accrual and cash accounting requires a deep understanding of both the underlying transactions and the relevant accounting standards. Moreover, complex transactions, such as mergers and acquisitions, joint ventures, or hedging arrangements, may necessitate specialized knowledge and judgment to ensure proper classification and disclosure. Advancements in technology have begun to transform the preparation of cash flow statements, automating routine calculations and enhancing the accuracy and timeliness of reporting. Enterprise resource planning, ERP systems, and financial management software now offer integrated modules that can generate cash flow statements directly from transactional data, reducing the risk of error and freeing up finance professionals to focus on analysis and interpretation. Nevertheless, human expertise remains essential, particularly when it comes to interpreting unusual transactions, applying judgment in gray areas, and communicating the story behind the numbers. The regulatory environment surrounding cash flow statements continues to evolve, with standard setters such as the International Accounting Standards Board, IASB, and the Financial Accounting Standards Board, FASB, refining their guidance to promote consistency and comparability. Under International Financial Reporting Standards, IFRS, for example, IAS 7, Statement of Cash Flows, prescribes the structure and content of the cash flow statement, while encouraging, but not requiring, the use of the direct method for reporting cash flows from operating activities. U.S. Generally Accepted Accounting Principles, GAAP, meanwhile, provides similar guidance under ASC 230, with some differences in terminology and presentation. Companies operating across jurisdictions must be mindful of these nuances to ensure compliance and facilitate cross-border analysis. Beyond the technical aspects of statement preparation, the cash flow statement plays a vital role in strategic decision-making. For example, a company contemplating a major capital investment must assess not only the projected returns but also the timing and magnitude of cash outlays, and whether internal resources are sufficient or external financing will be required. Similarly, businesses facing periods of economic uncertainty may use cash flow projections to stress test their liquidity, identify potential shortfalls, and develop contingency plans. The cash flow statement thus serves not only as a record of past performance, but as a foundation for forward-looking planning and risk management. The interpretation of the cash flow statement requires a nuanced understanding of the interplay between operating, investing, and financing activities. A company with robust operating cash flows may signal a strong underlying business, while persistent negative cash flows from operations could indicate fundamental weaknesses, even if reported profits remain healthy. Conversely, large outflows for investing activities may reflect strategic expansion, but could also strain liquidity if not supported by adequate operating cash flows or financing. Financing activities, meanwhile, can reveal shifts in capital structure, dividend policy, or management's confidence in future prospects. Analysts often supplement the cash flow statement with a range of ratios and metrics to deepen their insights. The operating cash flow ratio, for instance, compares cash from operations to current liabilities, providing a measure of short-term solvency. Free cash flow, calculated as operating cash flow less capital expenditures, indicates the amount of cash available for debt repayment, dividends, or reinvestment. The quality of earnings ratio, which compares cash flow from operations to net income, helps assess the extent to which reported profits are backed by actual cash generation. These and other tools enable stakeholders to move beyond surface-level analysis and uncover the true drivers of financial performance. In summary, the preparation of the cash flow statement is a multifaceted process that demands technical proficiency, analytical acumen, and a keen understanding of the business context. From gathering and organizing financial data, to classifying and adjusting transactions, to reconciling balances and ensuring compliance, each step plays a critical role in producing a statement that faithfully represents the company's cash flows. As the business landscape grows ever more complex, the importance of the cash flow statement, as both a reporting requirement and a management tool, continues to rise. By mastering the art and science of cash flow statement preparation, finance professionals equip themselves to navigate uncertainty, drive performance, and create lasting value for their organizations and stakeholders. The journey of preparing a cash flow statement often begins with a careful review of the previous period's statement, as well as a thorough examination of the current period's financial records. This historical perspective allows preparers to identify trends, recurring transactions, and potential anomalies that may warrant further investigation. For instance, a sudden spike in accounts receivable may suggest either increased sales or deteriorating collections, each of which carries different implications for cash flow. Similarly, significant changes in inventory levels can signal shifts in demand, supply chain disruptions, or changes in inventory management practices. Once preliminary analysis is complete, the next step involves mapping out the specific transactions and account balances that will feed into each section of the cash flow statement. This mapping process is crucial for ensuring that all relevant cash flows are captured and appropriately classified. For example, cash received from the sale of goods is an operating cash inflow, while cash paid for the purchase of new machinery is an investing cash outflow. Dividends received from investments may be classified as either operating or investing cash inflows, depending on the applicable accounting standards and the nature of the investment. A key challenge in preparing the cash flow statement lies in distinguishing between cash and non-cash transactions. Many events that affect the income statement or balance sheet do not involve the movement of cash. Depreciation and amortization, for example, reduce reported profits but have no impact on cash. Conversely, the payment of a supplier invoice reduces both cash and accounts payable, affecting the cash flow statement but not the income statement. Accurately identifying and adjusting for these items is essential for presenting a true and fair view of cash flows. Another area requiring careful attention is the treatment of extraordinary or non-recurring items. Large one-time transactions, such as the settlement of a lawsuit, the write-off of obsolete inventory, or the receipt of insurance proceeds, can have a significant impact on cash flows and may need to be disclosed separately to provide clarity to users of the financial statements. Similarly, transactions involving related parties, foreign subsidiaries, or off-balance sheet arrangements may introduce additional complexity and require specialized disclosure. As the cash flow statement takes shape, it is important to maintain clear documentation of all assumptions, calculations, and adjustments made during the preparation process. This documentation not only facilitates internal review and audit, but also supports transparency and accountability in financial reporting. In the event of questions from management, auditors, or regulators, well-organized working papers can provide the necessary evidence to substantiate the figures presented in the cash flow statement. Communication is another critical aspect of the cash flow statement preparation process. Finance professionals must be able to explain the rationale behind their classifications and adjustments, articulate the implications of key trends and variances, and respond effectively to queries from stakeholders. This requires not only technical expertise, but also strong interpersonal and presentation skills. By fostering open dialogue and collaboration across departments, finance teams can ensure that the cash flow statement serves as a valuable tool for decision-making and performance management. In larger organizations, the preparation of the cash flow statement may involve coordination across multiple business units, geographies, or functional areas. Consolidating cash flows from diverse operations requires a standardized approach to data collection, classification, and reporting. Differences in accounting practices, currencies, or local regulations must be reconciled to produce a unified statement that accurately reflects the group's overall cash position. This process is often facilitated by the use of centralized financial systems, standardized templates, and regular training for finance staff. The cash flow statement also plays a vital role in external reporting and investor relations. Publicly traded companies are typically required to include a cash flow statement in their annual and quarterly filings, providing shareholders and analysts with critical insights into the company's liquidity, capital allocation, and financial strategy. Effective communication of cash flow trends and drivers can enhance investor confidence, support valuation, and facilitate access to capital markets. Conversely, unexplained fluctuations or inconsistencies in the cash flow statement may raise concerns about the company's financial health or the quality of its reporting. In addition to its role in historical reporting, the cash flow statement provides a foundation for forecasting and scenario analysis. By projecting future cash flows under different assumptions, companies can assess the potential impact of changes in sales, costs, investment plans, or financing arrangements. This forward-looking perspective is essential for budgeting, capital planning, and risk management, enabling organizations to anticipate challenges and seize opportunities as they arise. The preparation of the cash flow statement is governed by a set of established principles and conventions, but also requires judgment and adaptability in the face of evolving business models and transactions. For example, the rise of digital platforms, subscription-based services, and complex financial instruments has introduced new types of cash flows and reporting considerations. Finance professionals must stay abreast of emerging trends and regulatory developments to ensure that their cash flow statements remain relevant, accurate, and informative. Training and professional development are therefore essential for those involved in cash flow statement preparation. This includes not only technical training in accounting standards and financial systems, but also broader skills in data analysis, business strategy, and communication. By investing in the capabilities of their finance teams, organizations can enhance the quality and impact of their cash flow reporting, supporting better decision-making and long-term value creation. Ethical considerations also play a role in the preparation of the cash flow statement. Transparency, integrity, and objectivity are fundamental to ensuring that the statement provides a true and fair view of the company's cash flows. Manipulation or misclassification of cash flows, whether intentional or inadvertent, can undermine stakeholder trust and expose the organization to legal or reputational risks. Robust internal controls, regular audits, and a strong ethical culture are essential safeguards against such risks. Looking ahead, the role of the cash flow statement is likely to become even more prominent as stakeholders demand greater transparency and accountability in financial reporting. Environmental, social, and governance, ESG considerations, for example, are increasingly influencing investment decisions and may lead to new forms of cash flow disclosure related to sustainability initiatives, social impact, or climate risk. Companies that can effectively integrate these considerations into their cash flow reporting will be better positioned to attract investment and build long-term resilience. In conclusion, the preparation of the cash flow statement is a complex but rewarding endeavor that lies at the heart of effective financial management. By providing a clear and comprehensive view of cash movements, the statement enables organizations to monitor their liquidity, allocate resources efficiently, and communicate transparently with stakeholders. As the business environment continues to evolve, the ability to prepare and interpret cash flow statements will remain a critical skill for finance professionals and a key driver of organizational success.